welcome to The Money Mindset. Now, the guest on my show today is someone I've been chasing for a while, and finally he's here. He's flown down to India, and we have the chance to speak to him, understand a lot about his journey. Mohnish Pabrai, thank you so much for being here with us.
Well, great to be with you, Sonia. I love the content you put out, so wonderful to be here.
Thank you. I've been following your journey for very long, and it is inspiring. It is, I aspire to be like you someday, to be, an investor, a businessman, a philanthropist, doing all kinds of amazing work. But there is this whole section of the younger generation that perhaps has not even heard of you. So today my endeavor is to learn from you and to hear from you about your journey.
All right, well, let's get into it.
So where do we begin?
Wherever you'd like.
So as I said, right, investor, businessman, philanthropist, what best describes your journey?
Well, I would say probably what describes me best is I had a couple of industrial psychologists do a bunch of tests on me now, maybe I think 26 years ago. And their conclusion was that he likes to play games. Even though you put up all those different kind of words to describe me, I would say probably the most accurate would be that I like to play games, but then they qualified that. They said that you like to play games, but you like to play games where you think you have some edge to win. And so you pick the games, and you are a single player game player. So I'm not the kind of guy who would like to be on a soccer team, for example. I'm more likely to want to play, which I do play. I play bridge, for example, right? So more single player games. And so basically, when you look at the Dakshina Foundation, we have, I describe it as a game, right? And even if I look at Pabrai funds, I describe that as a game. So these are all games. And at the end of the day, I've always felt that life, for the most part, doesn't have a lot of meaning. We're randomly here on some blue dot, and we're here for some time, and then we're gone. We're here for a relatively short period of time. So try to make the most of it in that time and try to have the most fun. So that's how I kind of process it.
Wow, this became philosophical very soon. I was hoping this would happen a little later on the show. But I'm glad you brought that up because, for you, whatever you've touched has worked really well, right? Whether it's Pabrai funds, whether it's your association with Warren Buffett, Charlie Munger, and over the years, you've had sort of a ringside view on their life, their journey. Tell us a little bit about that. How did you begin? And when did you kind of first meet them? What was your association with them? And what has your biggest learning been from them?
Well, first of all, I would just clarify, there's been a lot of things that didn't work, right? So even though you're pointing out that some things have worked. So I've tried many things in life. Usually when I'm trying something new, it's small, right? So if something is small, then it tends to be contained. If it's showing traction, then I can, kind of press on the accelerator. So there's been many endeavors that I've had which have not worked. And in fact, the ones that don't work are the most important ones because they are the ones that actually teach you. The ones that do work don't teach you anything. So I always cherish the failures. So that's worked out well. And I think in many ways, I feel like Forrest Gump, right? So we are not supposed to be able to touch Warren and Charlie. We're not supposed to be able to be friends with them. And, there's these, big icons and, larger than life and all of that. But somehow I became friends with Charlie. And I'm not as good friends with Warren, but I have reasonable friends with Warren as well. That's not supposed to happen, So just these kind of weird things happen. And I take it as it comes and no complaints about it. And it's been wonderful actually because it's enhanced the journey. It's helped me become a better person. And it's been wonderful.
So I remember in 2008 when I started my career, I read this article about you paying $650,000 with someone else together to have lunch with Warren Buffett. And at that point, of course, the amount was large at that point in time, but I was just so amazed to hear about that because people don't do it. And of course, it's a huge opportunity if you do get to have lunch with him. So tell us a little bit about that.
Yeah, so I would just say this. So let's say if you lived in the time of Gandhi or Newton or Einstein, and if there was an opportunity to meet them for a meal, would you take that opportunity, right? So for me, Warren Buffett would be in the same genre, not quite Gandhi, but he's a capitalist and Gandhi's not. And unlike those guys, Warren every year was willing to take a bribe to have lunch with anyone, right? So he would run a charity lunch auction. And the way I looked at it is that I think I was trying to win the lunch from like 2004 onwards. So just kept not being the highest bidder. But, if at that time, I think in 2007, probably more than 70 million of my net worth was directly attributable to learnings I got from Warren. So my perspective was, I've gotten all these learnings. I've never paid any tuition bill. What kind of tuition bill makes sense? And I thought, well, if you pay 2 or 3% as a tuition bill, that's pretty cheap. I don't think it's that much, GST is a lot more than that. So my take was, why would I not want to pay that tuition? And I felt like here was an opportunity to actually thank my hero in person. And not only do I get to thank him, but I get to break bread with him. And so I said, okay, we're going to bid for this and see if we can win this. And as it turns out, from what transpired after that, it was like buy one lunch and get infinite lunches free. Because it led to a friendship with Charlie Munger. I used to meet Charlie every probably couple of months for dinner. I became a bridge partner of his and used to play bridge with him, the LA Country Club. So all of these things were kind of just really surprising for me. I never expected any of it. And so when I look back, that was a total no-brainer and worked out great.
What exactly happened at that lunch?
Well, so one of the things that Warren does, because he does these lunches every year, he's now stopped. The last lunch he did, I think, went for 26 million. So I got a great deal.
Yeah. Okay. In hindsight.
And there's no more lunches, so he's done with those. So Warren's perspective is that whenever anyone has won this lunch, they should at the end of the lunch feel that they got a bargain and they should feel this was tremendous. So he tries to do everything possible to make it an incredible experience for whoever's won the lunch. And the way it works is the rules are that you can bring up to 6 other friends with you, friends or family, whoever you want. And he told us when we started to sit down that I've got nothing going on all afternoon. So he said that I'm here as long as you want me. When you get sick and tired of me, you let me know and I'll leave. But there's no clock or anything. And I had gone with my family. So my daughters were 10 and 12 at the time, which is a great age actually. They both sat on either side of Warren. They were sitting on both sides of him. And then my friend Guy Spear came with his wife. So there were 6 of us. And Warren had the time of his life with my daughters. And basically, it was lucky that they were at that age because they were just old enough that they could comprehend a lot. Okay. And he gave them a lot of pointers. And in fact, he gave them advice that they still remember and understand till today. So for example, he told them that the most important decision they're ever going to make in their life is who they decide to marry. And that stuck with them. So it's not something I had to talk to them about. That was already done when they were 10 and 12. And
so why did he say that?
I think for women, it's a make or break. I mean, I think who your partner is going to make a massive difference in terms of the eventual outcome. So, and he knows that. I mean, it applies to men too, but I think it applies much more to women. And, a lot of women will make that decision with a lot of emotion, right? You kind of need a balance of heart and head, and so that's what is missing a lot of times. It's too much heart, too little head. And so that balance is important. Otherwise, you're going to kind of go off track and then it takes a while to get back on track. So yeah, he just had a great advice. And then any question we would ask him, he does this even at the Berkshire meetings, he converts these lemon questions into lemonade. So you ask him some question that's maybe not that great or whatever, but his answer will convert it.
Like, can you tell us something that...
Well, like for example, in the early 60s, there were actually 3 of them who did deals together or had some collaborations. It was Warren, Charlie, and a third guy named Rick Guerrin. And Rick Guerrin kind of disappeared, basically, for the most part, in the early 70s. So I said, okay, there were 3 of them, and then it just became 2 of them, right? And I didn't know what happened to Rick. So I asked Warren, I said, Warren, you and Charlie did all these different deals with Rick. What happened to Rick? Are you in touch with Rick, and how's he doing, etc.? And it was just a question I asked him, it was just a curiosity. I didn't have any agenda with that question. So he said, well, Rick and I are still in touch. We play bridge online. He just sent me a Christmas card and very much alive and doing well and all of that. But then he continued. He said that Charlie and I knew very early that we would get very rich, but we were not in a hurry to get rich. He said Rick was in a hurry. So he said that Rick was a very good investor and still is a very good investor, but at that time he was using a lot of leverage, right? So he actually had margin loans. And in 73, 74, there was a huge drawdown in the US markets. So Warren said that Rick got margin calls and he was forced to sell his position. So Warren said that Warren bought Rick's Berkshire stock at $20 a share, which was the price at that time. It had fallen from 40 to 20. Those shares are now worth 700,000 a piece, right? Wow. US dollars. So it went from 20, it's 35,000x since then, right? And then he continued further. He said that if you're even a slightly above average investor and you spend less than you earn and you use no leverage, you cannot help but get rich over a lifetime, right? So, I mean, how simple is that, right? And he converted a question I had about Rick. I was just trying to figure out what happened to Rick. And he converted it into
a life lesson.
Into a leverage. And then later what happened is that when I started playing bridge with Charlie, Rick was one of his bridge buddies and his buddy for since then. So I got to know Rick really well. And he passed away a few years ago, just wonderful guy. And so it just came full circle. And it was great. So I think that's what Buffett did, is that he would just look at any question or anything we were asking, and he'd answer it in a way that would try to deliver a lesson.
So 2 lessons that stayed with me in this. One is don't take leverage. It's really not required.
Yes.
And the second is, I guess you just have to do the basics if you want to kind of get rich, which is, use the power of compounding and, start your investment journey early.
Yes.
What else did he talk to you about that? I'm just trying to understand, what are the 5 or 6 things that you need to follow if you want to become a successful investor?
Well, so one of the things he talked about was this concept of the inner scorecard versus the outer scorecard. So he said, do you want to be known as the best lover in the world, but internally know that you're the worst? Or do you want to be known as the worst lover in the world, but internally know that you're the best? And he said, if you know how to answer that question, you're very far along towards being a success. So the inner scorecard is a very powerful framework to use, which is that the way we ought to measure ourselves is by the inner scorecard. So we shouldn't really look at the way the world looks at us, because the world doesn't know about all the flaws and warts and everything else. We do, right? And that's really the benchmark to use. And so if you use the proper scorecard to measure yourself, you're going to end up being a better person and a better life. The other thing he was saying is that he said, if you hang out with people better than you, you're going to get better. If you hang out with people worse than you, you're going to get worse. So there's a gravitational pull both ways. And so most humans are not going to be willing to put this framework ahead of loyalties. But in order to have a great life, you actually need to be, and this is not Warren's word, but my words, it is you need to be a harsh grader of humans. So what you have to focus on is that when you do an assessment of your friends, you're going to find that they are on a whole spectrum, right? And you have to take deliberate action to increase time with the ones that are exceptional and decrease or even eliminate the ones who've got issues or whatever, where they're pulling you down in some way. And that is a difficult thing for many humans, right? Because it goes against the principle of loyalty. But I would say the principle of hanging out with people better than you, in my opinion, trumps the loyalty. If your objective is to, go as far as you can in life and have the best possible life and have the happiest life. So the thing with life is that we constantly get to forks in the road, right? And which fork are you going to take? And so if you have these frameworks, then I think those forks become really simple.
So talking about the inner scorecard, right?
Yes.
If you do figure out the hack of not letting the outside world affect you and having your own internal mechanism where you'd rather prefer being called not the best lover outside, but knowing that you're the best lover inside, you figure that hack out.
Yes.
What does that actually mean? I mean, how do you take that forward into your professional journey?
Well, that inner scorecard is going to form the baseline for growth. Because you don't have illusions, based on what people think, who you are and what you are. You internally know where you're at. And then you can make a kind of a rational assessment of, okay, this is who I am. This is what my strengths and weaknesses are. And I can do X, Y, Z to play the game of life in a wonderful way. Right? And so having the reality of who you are and where you are is just very fundamental, and not having that polluted by what people say. Like, when we started talking, you brought up some of the things I've done. Well, but I'm more concerned with the things that haven't worked, right? Because those are actually the relevant ones. We don't want to sweep them under a rug. It's easy to sweep them under a rug. I think that those are the ones that are truly going to teach you, right? So what I've always found, this is interesting about life, it's really amazing how this has worked. There was a Roman emperor, Marcus Aurelius. So the first Gladiator movie, Marcus Aurelius shows up in the first 5 minutes, the old king. And he had a very difficult life. So he spent his whole life on the battlefield, a lot of injuries, a lot of sicknesses, really tough life. And over the course of his life, he came up with a philosophy, and it's called the stoic philosophy. Yeah. And he wrote this book, Meditations, right? So if you just kind of boil, Aurelius down to the core, he says that to encounter misfortune and overcome it is good fortune. So what he's saying is that whenever we encounter adversity, at the time we are facing the adversity, we feel terrible. Like, oh, why is this happening to me? This is so bad, whatever else. But what he's actually saying is that particular adversity, once you've gone past and overcome it, it is that adversity that's going to lead to greater growth. And what I found, which when I look back, I'm going to be 61 this year, when I look back, there has never been a case in my life. There's been lots of adversity. There's never been a case in my life where any of those adverse things did not lead to greater growth. I cannot even point to, it's stunning. I would think that there'll be some exceptions to this rule. Because and so the interesting thing about that is, so if you flip that on its head, and now what happens is that when I hit challenges or adversity, I'm actually smiling through it. It's like I'm like kind of observing it and saying, okay, yeah, I know I'm going through this. I know this is a bunch of nonsense to it, but I know what's going to happen on the other end. I don't know how and why and when that will happen on the other end, that I'll get some fruits from all of this, but I know it's never failed me. So in some ways, we should welcome adversity.
But there is this difference between having a scarcity and an abundance mindset, right? In every way. So when you talk about adversity, when people are hit with adversity, if you have a scarcity mindset, you generally have a victim complex as well. And then you get sort of sunk into that. How does one move from a scarcity to an abundance mindset in all fields of life, whether it's, in investing, whether it's in your personal life, in your professional journey?
Not easy. I mean, I think, like I said, to me, I think the hack I use is knowing what Aurelius said, knowing what Marcus Aurelius said, knowing that this has actually transpired in 20 different ways in my life in the past, and knowing that it transpired in his life in different ways. So it's just, I think, faith. Faith is a big part of this, that you have to have the faith that the sun will rise tomorrow, and you will rise with the sun, and tomorrow will get better than today, and the day after will get better than the day tomorrow, and so on. So I think you have to have faith, and you have to put one foot in front of the other. So a good piece of that adversity is that you have to confront it head on. So you shouldn't draw the covers and withdraw. You have to confront it and face it strongly. And that's what's going to help you overcome, and that's what's going to help you get the best growth out of it. So basically the beautiful thing about that philosophy is there's never downside in life. Because if things are going well, that's fine, everything's fine. And things are not going well, that's even better.
I want to talk about that, because if you believe that there's never a downside in life, now when you extend that to, say, making money or investing, right? You do go through several phases, and you have been investing for maybe 30, 40 years now. I'm sure you've seen drawdowns of 30%, 40% at some point in your investing journey. Now that is a clear downside. You can see it in your portfolio. What do you do at such a time? And I'm asking because we are in this phase in the Indian markets as well, when we are seeing a sort of the onset of a bear market, perhaps. How do you hack that?
A long time ago, we were told, if wealth is lost, nothing is lost. If health is lost, something is lost. And if character is lost, everything is lost. You're just talking about the first one. The first one, the saying is, if wealth is lost, nothing is lost. So we don't need to worry about the wealth part. Now, it's a little different in India, but in the US, my father-in-law passed away. And when he used to visit us in the US, he used to say, the US is the only country in the world where the poor people are fat, okay? So if you see a beggar on a street in Mumbai, and if the beggar is fat, okay, first of all, we've never seen such a sight, right?
It's rare.
Okay, but if you saw a fat beggar on a street in Mumbai, nobody will give that person any money. They'll just look and say, why is he begging? He's already so fat. He should not be eating
healthy
food. So basically, what my father wanted to say, in the US, the poor people are fat, which is probably true. If you do analysis, you might find that the caloric intake amongst the lower end of the population might be higher. The reason for that is that the US has a safety net, right? So we do have a homeless problem in the US. It's a small portion of the population, I think probably well under 0.25% of the entire country. Most of them have issues with mental health or drug abuse, right? So if you take that out, it may be even much smaller number. So what I tell people is that if you lose your job, for example, you're not going to starve, because the statistics in the US is the poor people are fat, okay? You're not going to because the safety nets are there. And so there's a baseline. And things will take care of themselves. Even in India, when I was growing up, my parents were very poor financial planners. My dad went bankrupt several times as an entrepreneur. And they never had any savings. And we had to rely on friends and family, even for groceries and rent and things. It was tough times. But at the end, you pull through and move on, right?
So you never came from a family of wealth?
Well, there were periods of time when we had wealth, and there were periods of time when there was nothing. So it was a big roller coaster. So when my dad was an excellent guy at figuring out business opportunities, starting businesses, but he was very aggressive in terms of wanting to grow it as fast as possible, a lot of leverage and such. And so these things would blow up with some regularity. And so it was feast or famine. And because they never saved, when things were going well, they were living well, they were spending well, everything was going well. And then it would just crash and go the other way. So one of the lessons I took from that when I was an adult myself is we're going to have like 15%, like when I started working, 15% going into my 401k, my retirement plan. We're going to keep that and we're going to continue to kind of build on that. So we're never going to have this type of situation, So we look at that and we learn and take it from there. So I think with the Indian markets, the markets going down. So if you study equity markets around the world, and I'm the most familiar with the US market, so I'll just give the US market example, is from 1965 to 1982, major index, the Dow, was flat. So it was 865 in 1965, and it was 865 in 1982. 17 years, zero, right? Then from 82 to 99, it went from 865 to like 12,000. Exponential growth. I mean, everyone was double digit, doing extremely well. And then from 1999 to 2012, zero, right? Now, from 65 to 82, the US economy grew a lot. And a lot of good things happened. Some bad things happened, but a lot of good things happened. What happened is in 1965, stocks were very overvalued. And in 1982, they were extremely undervalued. I mean, you could buy Coke for 7 times earnings, Procter & Gamble for 6 or 7 times earnings. Everything was very cheap. Everything was on sale. In 99, it again got overvalued. And if we go back to, and we look at the Sensex, and we go back we don't even go that far. We go since, let's say, 91, when they started doing the reforms, last 35 years. You will find long stretches where the Sensex is zero. And you will find also some long stretches, or even maybe not that long stretches, where it's doing 20% a year, 18% a year.
Yeah.
But when you average it out, it's had a tremendous run, right? And so I think the important thing to understand is that for most investors, they are not going to be able to figure out how to value a business. The good news is you don't need to figure out how to value a business. So you buy a low-cost broad index fund and you dollar cost average into it, or rupee cost average with the SIP every month, put some savings in. And you don't worry about the markets going up and down. You keep that plan. Now, this is not what most people are going to do, right?
This is what I do. So
yeah, but that's
long back I stopped, worrying about investing in direct stocks, and a large chunk of my money is in index funds, because I've realized when you average it over a period of time, you can never call the market. So you just leave it to professional fund managers.
Yeah, and the thing is, you keep your frictional costs down.
Yeah.
And basically, the good news is that the index is too dumb to know that it owns Google. And it's too dumb to ever sell it. Okay? So it will hold Google for 30, 40 years, which an individual investor is going to not do. They're going to dance in and out of Google, right? And the same thing here. I mean, it's going to own Asian Paints for a long time, and HDFC for a long time, and Titan for a long time, and all of that, right? The index is just going to own those things because it doesn't bounce in and out.
But there's an argument here, right? I mean, if you said Asian Paints, HDFC Bank, these are stocks that have really not given any returns to investors, despite being amazing companies
for some time.
3, 4, 5 years, right?
Very short period.
Yes. So it's a short period. I agree in a time span of, in a journey of 30, 40 years. But like I was talking to Ramesh Damani the other day, and he said, Sonia, you will make money in mutual funds, in SIPs, but you will be able to create real wealth when you identify stocks on your own.
Yeah, but let me give you a counterpoint. So, we have the Nifty in India. We had a little different Nifty in the US in the early 70s, late 60s, called the Nifty-Fifty at that time, which is not to be confused with the Indian Nifty-Fifty. These were 50 ultra blue chip, high flying stocks. And at that time, the theory was You don't worry about how expensive they are. You don't worry about anything. They're such strong businesses. You just blindly put 2% of assets into each one and leave it alone. Now, there is some controversy whether Walmart was part of that Nifty-Fifty or not, right? Let's just take the case that Walmart was one of those 50 stocks, right? And it would have been 2% weightage of the entire index when you first started. And let's say now a lot of the Nifty-Fifty stocks are from that time. They included companies like Xerox, Polaroid, Kodak. These have gone to zero.
Yes.
A lot of them have gone to zero. If you take the entire Nifty-Fifty and take 49 of the 50 to zero, and you only leave Walmart, the 2%, and you run it till today, it beats the S&P. It's a solid double-digit return with 98% of the portfolio taken to zero. Wow. Okay, so what is the lesson there? Now, I know it's not an Indian example, but I'll just give you a little bit of, so Walmart, when it went public, Sam Walton already had transferred the shares to his family. So the Walton family, at the time Walmart went public, owned 36% of the company, okay, at the IPO. Sam Walton has been dead for, I think, 35 years. There are no Waltons who are in management in Walmart at senior levels or anything. There may be one or two on the board. Today, the Walton family stake in Walmart is 44%. It's 50 years after the IPO, more than 50 years. It's 55 years after the IPO. 55 years after the IPO, the family's ownership in Walmart is higher than it was at that time, okay, 55 years ago. And they've done extremely well. They're very wealthy and all of that, right? So what the index does for you is it will keep Walmart forever for you. It will keep Asian Paints forever for you. And you don't need to worry about it. And what the index is also going to do, it will take out Xerox and it will take out Kodak. So every year, one or two of the losers will go away and they won't get it right always. But we don't need, so in that particular example, you only needed to hold Walmart at a 2% weightage in your portfolio 50 years ago and just not touch it. And everything was fine, right? So the single most important skill that an investor needs is patience. So if you are the kind of person who loves to watch paint dry, you will do extremely well as an investor. If you get anxious watching paint dry, it's not going to work well. So like, for example, HDFC, Asian Paints. Now, for people like me who value stocks, they were ridiculously overvalued. I don't even know if they're currently fairly valued. They may be overvalued, but they are exceptional businesses. I wrote an article, I think in 2001 or 2002, or maybe it was 2000, where I pointed out how overvalued Infosys was. Infosys was really ridiculously overvalued at that time in 2001. And for a long time, 8 or 9 years, the returns to investors were zero. But if you ignored Mohnish and you just held Infosys from then till now, you did extremely well. It got past that overvaluation, the business kept growing and improving, and it's worked out very well. I had the same issue with Microsoft. Microsoft from 2000 to 2012, the returns were zero.
For 12 years.
12 years, zero returns.
Wow.
Okay, it wasn't just zero. It went from 600 million market cap, 600 billion market cap, sorry, to less than 200 billion. So it wasn't just flat line. It was serious drawdown and then coming back up. But for 12 years, if you just held for 12 years, you were zero, which is not a great result.
And there's an opportunity cost.
There's an opportunity cost. But again, if you just held Microsoft from 2000 till today, it's not great, but you had about a 5-6x. Okay, you still had a 5-6x.
That's great.
Well, 5-6
for an average investor.
5-6x is 25 years is not that great. It's okay.
Yeah, over
it's okay.
25 years.
But what I'm saying is that Microsoft was one of the most overpriced companies. It was one of the best companies at that time in 2000. but it was very overpriced. So it is in the nature of equities that they are going to get into some periods when they get severely overvalued. There'll also be periods when they get severely undervalued, and there are periods when they may be normal. It's all of the above, right? And if you are a know-nothing investor, buy the index.
What's a know-nothing investor?
A know-nothing investor who doesn't know whether a stock is
yeah.
overvalued, undervalued, whatever.
Who has no time to research.
Yeah, and so, but I'm just saying, if the know-nothing investor just buys the index and, the next HDFC or the next Asian Paints is in there. We just don't know which one it is, but it's in there. And you just let it stay in that index for 30, 40 years and life is going to be great.
So, I was watching an interview that you did recently where you were talking about Warren Buffett and Charlie Munger's style of investing. And in that you said, one of the most important decisions you make is not the stock you buy, but it is how to not sell that stock. So basically watching the paint dry. Do you still believe in today's disruptive world that once you buy a good company, you hold it in perpetuity, or whatever your time frame is, or do you need to keep evaluating every 5-6 years?
I think the interesting thing about that particular statistic is that there are some businesses which have great moats and great cultures. And we have a lot of history with these businesses where they've been around for decades, 50 years, 75 years, even beyond, right? And I think that so if you were a stock picker, obviously you want to be able to ride that business for as long as the fundamentals are in place. And there's the question that comes up is, what is a signal and what is noise, right? We have to separate the signal from the noise. And what an investor is better off doing is having a heavy bias towards thinking everything is noise. So when you get to irrefutable declines, so I would say that in general, if you bought a business fairly priced or underpriced, selling it just because it became overpriced, if it's a very high quality business, may not be the most prudent thing. But if that business goes into what is obviously secular decline, then you have to get off the bus.
So you want to give me some examples, like for now, if you had bought, say, Nvidia 3 years ago, 4 years ago, is this a good time to be selling? Should you hold names like Tesla? Everyone's talking about Palantir and, the kind of growth that we're seeing there. So how do you deal with some of these names that are, kind of frenzied or buzzwords?
So 99% of stocks should go into what Buffett calls the too hard pile. Okay, so there's actually a box on Buffett's desk which says too hard on it. Okay. And he actually has a box where you can put papers in, which says too hard.
Okay.
When I went to his office, I saw that box and I said, Warren, the box is empty. So he said, Mohnish, it's not supposed to be empty. So he took a bunch of papers and dumped it in the box and said, see, it's full now. Okay, so he was just kidding with me. But basically, if you ask me, okay, so what does Nvidia look like 5 years from now or 10 years from now? It goes in the too hard pile. It's not a question I need to answer, right? So I only need to answer that question if I'm going to make an investment in Nvidia. And so let's take Nvidia as an example. So, there's a lot of buzz about it, right? The question I would have asked investors to ask themselves is, tell me what you think Nvidia's cash flows are going to be 5 years from now, 10 years from now, 15 years from now. If you know these numbers with high conviction, then the next question, which is, should you buy or sell Nvidia, becomes obvious, right? Because you can look at those cash flows and decide the stock is too expensive or too cheap or whatever and make that decision. I don't know what Nvidia's cash flow is going to be 5 years from now or 10 years from now, 15 years from now. Too hard pile. Palantir, too hard pile. What was the other one you said?
Tesla,
definitely too hard pile. What I'm saying is it's a tremendous company. It's done great. The valuation doesn't make sense based on current cash flows, but we have Elon, who's not human, And I mean, Elon is constantly underestimated by everyone. I mean, now he's fixing the US. That's incredible. So it would fall in a too hard pile. And so
what falls in the other pile? What are the stocks that are low-hanging fruits?
yeah, so basically the good news with investing is globally there are 50,000 or more stocks. We can do extremely well if we knew nothing about 99.9% of them. We would still have few hundred stocks to look at that we could actually think about. So if we just use the simple framework that I don't want to take risk, I don't want to make bets where I'm making some assumptions on cash flow where I don't have high conviction. With 50,000 stocks, you can get whatever you want delivered to you on a platter if you're flexible. So, for example, 6 years ago, I started making trips to Turkey, right? And I started going to Turkey because it was screening extremely cheap as a market. It was screening as the cheapest market in the world. And I also went there because I have a good friend there who's kind of die-hard Ben Graham type deep value investor. I think he's now like the second largest fund manager in Turkey. And he was much smaller then. And I told him, listen, I'd like to come to Istanbul. And if you're okay with it, I'd love to visit the companies in your portfolio. And he said, oh, that'd be a lot of fun, Mohnish, why don't you come? So I said, here are the rules. Don't take me to see any businesses where you don't have money invested. Okay. And I want to start with the business where you have the most conviction, the highest stake out of the portfolio you manage, and then work our way down, okay. Right? He said, yeah, fine, no problem, right? So when I started visiting these companies in Turkey, the currency was very unstable. Inflation was extremely high, and all the foreign investors were running to the exits. Mass panic, extreme panic. So I focused on businesses where the currency is not relevant. So there are some businesses, which I'll get to in a second, where inflation and currencies don't matter because it'll kind of work itself out. And the second thing that I did is when I visited there is I did no work on these companies. I decided I would do work on these companies after I met them. I said, at least let me meet them, know a little bit about them, then I'll do the work. So on my second visit in 2019, whenever we were driving to a company, I would start asking my friend Haider questions. Okay, what's the company? Who are they? And what's the market cap? What do they do? And all that, right? I'm just trying to kind of understand just basics. Because I said, once we meet, then I'll do the work. So he said, oh, Mohnish, this company we're going to meet, a company called Reysas, its market cap is $16 million US, 1.6. Liquidation value is 800 million. And they rent out warehouses to like Fortune 500 companies. So I said, it's trading at 2% of value. Is it a fraud? So he said, no, I have money in it. It's not a fraud. I said, why is it so cheap? He said, it's Turkey. Everything is cheap. Yeah. So I visited the father and son who run the company, and then I spent the afternoon visiting their warehouses. And you could have gone to any broker. They had like 60 properties. And you could have just said, okay, these are the properties. What is the value? The brokers would have told you the value of these properties is $1 billion US. There was 200 million of debt. And the liquidation value of that business was 800 million. So then I thought 16 million, there's going to be no stock to buy. It's illiquid. For $8 million, I got 1/3 of the company, which we still own today. The market cap now is over $1 billion.
Wow. And
the currency has collapsed. Like when I invested at that time, it was 5 lira to the dollar. It's now 36 lira to the dollar.
Wow, yeah.
So in lira, our returns are infinite. Okay, I don't even calculate what is it in lira. But in dollars, that market cap went from 16 million to $1 billion. But now the liquidation value of that business is more than 2 billion. So they've actually increased the value of the business.
What do they do?
They rent out large warehouses.
Okay.
So IKEA, Amazon, Carrefour, Toyota, Mercedes, all of these people have rented. So it's a very boring, simple business. It was just extremely mispriced. Templeton funds, at that time in 2019, sold me 5% of the company for $1 million, okay? Because someone in New York told them, exit Turkey, right? So what I discovered is that I was just buying the business. I didn't do a lot of work then because the value gap was so large that I didn't really need to understand a lot more detail about it. Over the years, I met them several times and I studied the business more. And what I discovered is that it's not just a cheap asset. They were very good capital allocators. They were very creative. They had entered a number of different businesses and they had always ended up being number one, number two market share. So this business basically is a business that we will not sell. The fund will not sell this business. We will sell when the founders sell. Okay? When I meet the founders, I meet them once a year, I tell them this company, Reysas, is my family business. I'm not in the management. I'm not on the board. I don't have any say in the business. I don't want any say in the business. You guys keep running it the way you want because if you get me involved, it will be worse. And I don't have to do anything. That's the other beautiful thing about public equity investing. You have to do no heavy lifting. You don't need to run the business or any of that. And you don't need too many of these in a lifetime, right? So if you end up, Charlie Munger used to say that you're going to get a trip to the pie counter very few times in your life. When you go to the pie counter, you have to load up on a lot of pie.
Correct.
Okay? Yeah. And because you're not going to get too many trips to the pie counter. So when you look at a business like NVIDIA, the question you've got to ask yourself is this a trip to the pie counter? And the answer is 3 trillion market cap? I don't think so. Okay? Because for it to be a trip to the pie counter, that 3 trillion market cap needs to go to 100 trillion. Okay? 100 trillion is a really big number.
Yeah.
Okay? It exceeds the market cap of the entire United States market. Okay? And definitely many times the Indian market. So we don't have any businesses like that. So basically, because we deal in auction-driven markets, so think about it this way. You go to watch a movie, okay, or you go to watch a play, and there are certain rules in this theater. Every seat has to be occupied. Okay, so now you bought a ticket to watch a play, and you got your seat, you paid $50 for your ticket, and you're watching the play. There's some smoke in one corner of the theater, and the fire alarm has gone off. Everyone is rushing to the exit. This theater has special rules. You can only leave your seat if somebody else takes it. So you paid $50 for that seat. How much do you think somebody would pay you to take that seat? Not $50, not even $1.
Yeah, because now there's smoke.
There's smoke. So that is the stock market, because every share has to be owned by someone. So if a company goes through any kind of temporary distress and the investors run to the exit, somebody else is buying those shares and going into the theater, right? Because they have the same information.
Yeah.
They have the same information and saying, oh, you're running out of the theater. Don't worry, I'm going to go in. The smoke doesn't really bother me. I'm okay. Okay? So we are looking for theaters where there is an illusion of smoke, not real smoke, an illusion of smoke. And many times the smoke will be real. We don't need to go there. But every once in a while, there will be illusionary smoke. So reason I went to Turkey was that my sense was that when you have mass exodus going on in the theater, the baby's going to get thrown out of the bathwater, right? I mean, there's a lot of good things will go away with bad things. So we have, I think at this point, I only have 2 businesses in Turkey in my portfolio, and something like 60 or 65% of the portfolio is Turkey. And I told my investors that we are not going to sell these businesses. They can sell their stake in the funds to bring down concentration, but we're not selling, right? And because trips to the pie counter are few and far between, I'm pretty sure till I pass away, I will not find another business at 2% of liquidation value.
Right.
That happened only once in my life, one and done. But for every investor in the market, there will be a few times in your life when you will clearly see that this is a glaring bargain, great opportunity.
You have to keep your eyes and ears open for that.
And you have to do it in size at that time. So Buffett says, when it's raining gold, don't put out a thimble. Put out like a big bucket.
Bucket.
Yeah, big bucket, not a spoon.
Correct.
You know?
That's
so you
amazing.
you have to capture those moments.
Okay, this has been like a masterclass in investing and in life lessons. So you started the conversation by saying that life has no meaning. Tell me more about that.
Well, I mean, if you, it's not really my philosophy. I think this would be, a lot of religions would get to that, in the sense that, we are circling a mediocre star on a mediocre planet in a mediocre galaxy in the middle of nowhere, actually closer to the edge of the universe. So the fact that somehow consciousness was created, life was created, and consciousness was created is an unusual event that took place. But we have to put it in context. The thing is, we are here for a short time and a lot of randomness in life. And there isn't really, I don't think there's a grand plan, in the sense that I think that a lot of this is just the way things happened.
So if life has no meaning, then why do people chase fame, money, success?
They haven't thought about it enough. So in my thinking of it, and I think that's why I became a game player. In my thinking, what jahan tak meri samajh mein aaya hai, that basically, so not much meaning in life. You try to leave the earth a better place than you found it. You try to improve it in some way so that the future generations have a little better time. And then I feel like, okay, to pass the time, just do interesting things that you're excited about. And I'm excited about playing games, right? So that's kind of how I approach things. It works for me, but I think each person is built differently. So they can figure out, the first, I would say, the first step would be whether you agree or disagree with the meaninglessness of life, right? If you agree with it, then the next step would be, well, how do you give it meaning, right? How do you make it so that it becomes a fun time in the brief time that we're here?
So when you say playing games, do you mean that everything you do is like a game for you and that's why you enjoy it? Because you don't attach any outcome to it?
Well, no, the outcomes are important because games have outcomes and outcomes are relevant, scores are relevant. But what I mean by the games is that, so for example, I think it's a big advantage to know when you're going to die, right? In my case, I'm going to die on June 11, 2054. Right? Little less than 30 years.
How do you know that?
So if you go on a website like, let's say, MetLife, which is an insurance company, you answer about 15 questions, they will tell you your life expectancy. Now I added some bells and whistles to it. I said, okay, my birthday is June 12th. Maybe I'll just go one day before my birthday. So it's a kind of round number, how many years, right? So instead of saying 2054, I can say June 11, 2054, make it more precise. And so the two games I'm playing that are relevant to that date is I have one engine that makes money, creates wealth. And I have a second engine, Dakshina, which gives the wealth away. And what I want to accomplish with this game is that one day before I die, June 10th, there should be like $10,000 left. Right? So the compounding engine will hopefully keep generating a lot of wealth. And the give back engine, which is now about 16, 17 years, needs to scale up over time and also give it away. And I don't want to just give it away. I want to give it away in a way where it does the most good for society. On the compounding side also, I want to try to play the game the best way I can. So try to increase the value for my investors and me the best I can with the lowest risk. And so to me, the reason it's a game is I could have retired when I was like 33, right? From then till now, all the wealth that's been created is not going to be consumed by me or my family. It's really going to go back to society in some way. So in effect, from then, that point onwards, it's really abstract. It's not really, it's there. It's kind of like, and this is a lot of Buffett influence, where he also says the money he has cannot make him happier by spending it. Whatever happiness he can get by spending money, he's already spending. But 99.999% of his wealth cannot help him become happier. He's already very happy. And so it will go to other uses and causes, and that's fine. So I think that, so you start with meaningless, then you say, okay, let's play games that we enjoy.
So if beyond a point money doesn't give you happiness, why do people keep chasing more and more wealth?
I think that when you start asking these questions, so if you go to you talk to the sages living in the Himalayas, who've given up everything and whatever else. Like, let's say someone like Paramahansa Yogananda, Swami Vivekananda, and all these guys. In my opinion, they got to some of the highest levels of evolution for humans. They transcended, for the most part, they transcended the physical, right? They figured out material things are not going to lead to greater happiness. There were other things that were going to lead them to greater happiness, and they pursued that path. Someone like me cannot be as evolved as them. I'm very far away from that, but I can make some. The more I move,
try to get there.
The more we go towards that, the greater the satisfaction we're going to get. So I think a lot of people just don't think about it. Like, for example, it's very clear to me that I don't want to have multiple homes. Okay. It's also very clear to Warren Buffett that he doesn't want to have multiple homes. He feels that multiple homes just creates more work and issues and whatever else. If I have to go someplace, take a hotel room or whatever, rent or whatever, and it's fine. To me, it's easier. I have friends who have multiple homes, and they live that life and they enjoy that life, and more power to them. So, but what I've always found is that less is more.
It's a journey towards detachment, basically.
Not so much detachment. I would say I'm never going to get detached like the way the Swamis are. But I think that I always ask myself that if I'm going to do X or going to go to X place or meet X person or whatever, is that going to make me happier or not, right? I always use that as a benchmark. And in fact, if I meet someone for lunch, right, or meet someone for tea or whatever, I always do a postmortem after that. I say, okay, that happened. Do we want to repeat that? Did we like that? Did we not like that? And what ends up happening is that you winnow it down to a set of people that you truly enjoy spending time with, and you have a lot of satisfaction and kind of commonality and whatever else, and you go from there. So I'd say less is more. A lot of people just don't think about it, and a lot of influences that come on people. You have media and advertising and all these things telling you what you should want.
And how you should live.
And what kind of life you should want. You should always want much bigger homes. You should always have much better cars. You should, have great vacations. So I actually feel like I'm on vacation every day, right? Many times I feel like if I go away someplace, it's worse than just my daily life.
You've hacked it, Mohnish. You've really hacked it. It's not so much about the money you've made, but it's about the mindset that you have sort of gained over time, right?
Yeah, but I think if you just think about, what, and again, it dovetails with the inner scorecard, because you're not looking at what will people think, right? We're completely disregarding what people think. We just focus on what is going to work better for us and less better for us, and just do it that way.
Wow. Okay, that's interesting. It's very interesting, actually. I mean, I think what really stayed with me is, of course, the inner scorecard. And when, both you and Warren Buffett think that beyond a point, money doesn't really buy you happiness. So in a sense, try to sort of give back to society in every way. But if you had to distill all the learnings that you've had in this amazing life of yours, where you started with, say, your parents becoming bankrupt, and then you went on to compound your money phenomenally well and, get into different markets and build wealth for yourself. If you had to distill this entire journey in 2 or 3 key life lessons, what would it be?
I think the important thing is, one of the most important things is to know yourself. And that's not easy because we don't come with an owner's manual, right? So understanding who we are, what we like, what we dislike, what we are good at, what we are not good at, then I think it's a pursuit of passion. So if you have a job, the question to ask yourself is, would I do this job if I was getting paid, right? And if the answer is no, it's the wrong job, right? So on a daily basis, what you are spending time on should really be something that is a passion.
But do you think you can say that now because you come from a place of privilege? Because for a lot of people, jobs are a means to an end, and despite not having passion, they still have to pay their bills and put food on the table, right?
So actually, it's a great point, and I'll just give, just dissect that a little bit for you. So when I was 25, I was working at a company, making like $40,000 a year. And I knew that I was not fully satisfied with what I was doing with them. And I had an idea of a business. And what I was doing is I was working on that business while I was working at the company. So what I used to do is, I didn't have any money. So I used to work like 6 o'clock in the morning to about 9 o'clock on the business. Then when I'd come back in the evening at 6 till about midnight, I'd work. And then on the weekends, I'd work on the business. And then if I had client meetings or something, I would take like a half a vacation day or one vacation day and meet them. And I did this for 9 months. And after 9 months, this was the third startup I had. The first two never went anywhere. I lost maybe $2,000-3,000 and they went away. But the third startup, this is one. After 9 months, I had a few clients and I could see there was enough cash flow that it was slightly above my salary, right? And I was dying to do it full time. Right? I said, if I can just do 70 hours of it and give up my job. But if I was going to leave my job and do that, I only had a guarantee or even a pseudo guarantee of that cash flow for about 3 or 4 months. Right? So all I knew if I left is that there is 4 months of like work and contracts and all that. And after that, it's an unknown. Right? But I used 2 or 3 kind of data points and principles. The first thing I said is, okay, I researched US bankruptcy law at that time when I was going, and it basically said that, okay, if you basically become personally bankrupt, because I had applied for every credit card I could get. So I had $70,000 of credit card limits I had not yet used. I had $30,000 in my 401k that I had not yet used. I knew that once I left, the paycheck would stop and this money would start getting used. So I knew at some point there would be $70,000 of debt. So my question was that, okay, if the business fails and I have to go back and take a job, what do I do with the debt, right? And I researched that I can declare bankruptcy, personal bankruptcy, and it would be wiped clean and I get to start over. So I said, okay, that's good. And I said, okay, I'm qualified and probably in a month or 2, I can get a job. So I said, okay, we're going to just go for this. I'm single. We have a shot and we're going to take this shot.
Right? Risk.
Right? I didn't see it as risk. Actually, entrepreneurs don't take risk. I saw it as pretty low risk because I felt like 1-2 mahine mein job mil jayegi and clear ho jayega, right? So I go in to resign to my job, my boss and his boss. And I tell them, I got this company I formed, it's not competitive with you in any way, and I'm going to go work on that. So they said to me, when it fails, not if it fails, when it fails, please come back. We'll give you more money, we'll give you a promotion, and you don't need to look for another job. So I said, this is actually better than I thought. Because the day it fails, I'm back to where I was.
You have a backup plan.
Right? And so I said, okay, this is even better than I thought because I won't lose 1 or 2 months looking for a job or something. I'm back, right? So I said, okay, great. And both of them later joined my fund, okay? Because they saw I never came back, right? So that business took off. But basically, so, when you're saying that I'm in a certain place, when I made the decision to pursue my passion, there really wasn't a big safety net. You know what I'm saying? I just knew that there was a few things going on, which is what most entrepreneurs have. They don't have a lot they can hang their hat on when they're going for it. And if it didn't work, I knew what the plan B was. And basically what I would have done, so let's say if it didn't work, go back to work, come up with some other idea, mornings, evenings, keep doing this, one more shot, right? Make some savings and go again. So that's what I would have done. But it just worked, and then I never had to look back from there.
Oh, wow.
I don't think you're ever going to be in a situation where, unless you're born with a silver spoon or whatever, but that you can just jump into something without really taking some
risk.
Some risk and some chance. But I thought the risk was low.
But it was calculated in a way.
It was calculated.
It was a calculated risk.
Yeah. And that's one of the things about entrepreneurs is that non-venture backed entrepreneurs actually don't take risks. They're really careful about this stuff. And it's not just me, because they think about these things carefully. And I knew that I had a degree, I had qualifications. There were a lot of people who would want my skills. So I knew all that. So I knew that it's not going to be like there's nothing, and I also knew that I was not yet married. There were no kids. And therefore, it was an easier decision. Yeah. So
lesser responsibilities,
Yeah.
absolutely. Okay, so let's wind down now. And, from your vantage point, since you've had this amazing journey where you've had access to some of the best, brightest minds in the investing world, what is your definition of a life well lived?
Well, I think a life well lived is you leave planet Earth better than you found it. It's really important to be a good parent. I think that one of the biggest responsibilities we have is we are in a position to have a huge influence on some very impressionable lives. So I think there is no substitute or anything for good parenting. So you have to be a great parent. No matter what else is going on, you have to be a great parent. And then beyond that, I think, pursue your passion. Do the best you can.
And when you say great parent, what is the definition of a great parent? Because I'm a parent as well, so I would love some advice on that front, considering it is a very, very tricky time right now when you have toddlers and sort of children who are all over the place. So what would your definition be of a great parent?
I think it's a mess, right? I mean the thing is I think the thing is that
it's chaos.
Like I think Mike Tyson says, everyone has a plan till they get hit in the face. So we're not going to have a plan with kids. But I think in general, just being conscientious and understanding that you've got these very impressionable lives and that you're responsible for them. You have to do the best you can for them. You have to help them. So one of the things, for example, that I had read a book, I think just before my daughters became teenagers, called The Hidden Logic of Teenagers, right? So one of the most important influences for kids after the age of 10 or 12 or so, yours might be younger, is who their friends are. So we end up not having much influence fairly early in their lives. Even after 12 or 13, we actually don't have much influence. What we have to do is we have to control, without them knowing that we're controlling, who their friends are. And so if you want to control who their friends are, you have to first understand who their friends are. So you do some hacks and some tricks. One is open your house anytime for pizza for everyone. Okay, or volunteer to drive them and their friends anywhere. So what happens is that when you're in the car, I actually didn't believe this when they said this in the book. They said that when you drive with teenagers in your car, don't speak. Be absolutely silent. In about 3 minutes, they'll forget that you're in the car and they'll start talking as if you are not there. Second thing the guy said is, no matter what you hear, don't respond. Because then they'll know you're in the car. So your job at that point is data gathering.
Just absorb.
And you will be shocked at the data you're gathering in those car rides. So those type of things will tell you whether your kids have the right friends or not. In the case of my younger daughter, she was in this art school. She was very artistic and all that. She was in the art school. And we realized that there was a big problem with her best friend. There was it was just really a can of worms. And I realized that if we tried to tell her to break it off, it wouldn't work. It just wouldn't work. So what we decided was that we were going to change the school. And when we told her that we're going to change the school, violent protest against that. Really, she thought we were villains, But we knew that there was no choice there. We just didn't have a choice there. And so we said, okay, we're going to have crazy couple of weeks.
Some hard decisions have to be taken.
And it worked. It actually, obviously her friend circle changed. But with teenagers, I think who their friends are really, really important. And so you will have to spend enough time with the friends to get to know them. The other thing about teenagers, another hack is, if you want to talk to them about anything, after midnight. Okay? So basically their energy levels and their body clocks are different from ours. After midnight, they're more amenable to accepting
Receptive.
what you are going to tell them. If you try it at 10 a.m., that's not going to work.
Okay.
So you got some advance warning.
And I have some time left before all of this hits me.
Yeah.
But Mohnish, it was such a pleasure speaking to you. Thank you so much for taking the time out. And I'm truly honored to have you sit here with me and spend so much time with me, because time is so important, as we've been discussing, and the kind of people that you meet. But thank you so much once again.
It was a pleasure. Thank you.
And I'm going to see you in Omaha for sure.
That'd be great. That'd be great. Sounds good.
Thank you for being on The Money Mindset.
All right. Thank you.